So yesterday I was paying attention to the New Zealand dollar and I noticed that the economy was quite in some sort of a limbo. I mean, let's take a look at this chart. The New Zealand dollar currently has an inflation that is not bad, but the employment is really high and the economic growth is kind of not there yet. So standard records of the economic data is at 0.26, but the central bank's view of it is at 0.01. This is the position of the New Zealand dollar right now, and in this video we're going to be looking at the New Zealand dollar against the Canadian dollar specifically, because the two conditions on both sides of both economy is nice enough for you to say this may be a trading opportunity here. The inflation state is literally dangerous. Why is it dangerous? Because they are having high inflation. The employment situation actually is strong, meaning there is inflation and there is job at the same time. People are making money, but the inflation is eroding the money as fast as they are making it. That is an economy where you make money today, the money is gone tomorrow morning. So put yourself again as a central bank manager. What do you think is the most reasonable thing to do with your interest rate? Do you think you should reduce it, hike it, or keep it where it is? Answer the question before you continue this video. Well, logically thinking, you don't just hike and reduce interest rate just because you saw high inflation and crazy data and all that stuff. No, they actually pay attention. What is the central bank's target in the first place in reality? And how far away from that target are we? This is where the latest gap actually comes in. Whatever the inflation rate is in that country minus the target the central bank has, you will know how far away it is. Currently, this economy is 2.1% away from the central bank's median target, which is around 2 to 2.5% most times. So what we're seeing here is an economy where the central bank is being forced to most likely increase their interest rates. The best thing you can ever pair this thing with is something where the central bank has almost zero need to touch their interest rates in going high, or even more need to push it downwards. First and foremost, we have the Canadian dollar. These guys have the best set of data you'll see here right now. They have a good central bank economic weight score. So central bank is looking at the economy at 0.63%, while the standard economic weight is at 0.6. Looking at the situation, they have good inflation data, good employment data, not so good economic growth, but inflation and employment is what really drives the economy. And you can see what it has here. The distance between the central bank target and the inflation rate is at 0.3%. It means that these guys have much more tendency to keep their interest rate where it is, or even reduce it as it stands. Now, we have two things we're comparing, the New Zealand dollar against the Canadian dollar. So let's take a really good look at that comparison for real. So just looking at both of them alone, you can see the comparison side by side, or rather up and down. The inflation state of both of them is stark opposite. We have the Canadian dollar where there is currently not bad inflation based on central bank's measurements, and the trend of the inflation data coming out over the last 3 releases is kind of mixed. So it's not going up and it's not going down consistently. It's fluctuating good. However, for New Zealand, the situation is quite different. The inflation rate is dangerously high. At the same time, the inflation trend is trending up, meaning they have inflation problems and it is still inflating yet. Then you take a good look at the employment state and the employment trend. The employment state for CAD is actually strong, but the trend is mixed. So up and downs as usual. The New Zealand dollar has a strong and mixed situation, but this is where the whole thing finds a good change. In the employment data, what is really happening? The employment quality check. So in Canada, we saw unemployment rate fell stably. It was a stable fall. At the same time, we also saw rising participation, meaning the people who were living the unemployment situation were actually getting job. Hence, there is more participation. And then when we looked at the New Zealand dollar, the unemployment rate increased and participation also rose. That is an economic state of employment is a big problem going on if they don't fix it. Even though it is trending up, it is still showing signs of weakness. Now look at their growth trend. Their growth trend as the economic state. The economic growth of Canada is neutral and it's trending up, meaning the last 3 sets of data has been positive for them. And then in the New Zealand, it is mixed. So they don't have a clear move to the upside yet or to the downside. They are just not clear in that case. With all of that in mind, take a good look at what the COT did on this particular market. Look at the COT flag. We had the Canadian dollar, the COT flag went bearish on it. So they decided, okay, we want to sell this currency because they are not going to be moving their interest rate anytime soon. And then they looked at the New Zealand. Ooh, this economy is quite confusing. They are crowded short. Now, crowded short means that they so much pushed the sell side that at this point in time, if they decide to start closing order, this market is literally going to spring in the opposite direction. But currently, they are seriously pushing to one side. By the time we get the release for this week, we'll know the real stance this guy have. Now, with all of that in mind, what actually is the central bank rate that is really going to determine this whole situation? The central bank rate of the Canadian dollar is at 2.25, and they have not raised it. The New Zealand dollar has an interest rate of 2.5%, and they recently raised it by 0.25 in their last release. So they already raised rates, and yet they are not seeing the results. This is a huge case for the New Zealand dollar. They really need to start seeing that results. They are seeing employment grow, meaning people are going to be making money, and if this inflation continues, they have a good reason to actually raise it even higher, because they can raise that rate because they know people will survive it. But if they are seeing a situation where employment was dilemma, was bad, they have no option. They can't raise that rate. But in this case, their employment is growing, so there's a tendency they can raise that rate. Now, with that logic in mind, let's go into the price chart. So in the price chart, we know we're looking for New Zealand long CAD shorts. Why? Because we know for a fact that there is a higher tendency for the New Zealand to raise their rates, and there's a higher tendency for CAD to either hold their rates or drop it. Now, where was their last meeting? Their last meeting was way back on 7th of July for the New Zealand, and then 15th of July for Canadian dollar, which is the base currency. If you pay attention to that interest rate movement, I want to show you right here below with an indicator I have. Take a good look at the indicator below the screen. What you will notice is, I'll turn off this too, is that on the day where the base currency, which is in New Zealand, released their interest rate increments, let's stay on the daily here to make it easier, you notice that when they raised that rate, we suddenly saw incoming orders for the New Zealand dollar. And now we're in a situation where we expect they may keep or even increase their rates, and then for Canada, they may keep or reduce their rates, which is a prime buying economy, being that New Zealand dollar is the base currency. Hence, this whole perspective has kept me in the knowledge of I'm looking for daily demand zones. Demand zones are places where I expect if the price should drop down enough to, I would want to be a buyer at this price. This is a cheap price to buy the New Zealand dollar using the card as a tool to buy. Now, with that in mind, I have this demand zone right here waiting for price to come down to it. If price is going to come down to it, I mean, price already dropped down to good demand zones in the past before. We had a demand zone down here, even though this is not the extreme types of demand zones I use. This right here is the extreme. But I don't expect price to find its way all the way down here. We have another demand zone here which price already respected. And when price respected it, you can see the move to the upside. And I'm expecting that price may most likely respect this demand zone we have here at 0.8193 to 0.8142. If price does respect it, we may move. But then again, you can see on my chart, I have a sell position right there at the top. Why would I be selling this situation? Well, we already have a feeling that the central bank is going to keep their rates. But before the central bank news comes out, you can see when they expect the next news to come out for both the quotes and the base currency. But before that news comes out, what do we see the market actually doing? Are they supplying or are they demanding? That's when we go into the lower time frame. On the lower time frame, I see a weak supply zone right here. So it's a base, it's a drop, base, drop right here. As you can see, I had a drop, the base, and then a drop. So price comes back into this zone, and this is where I use candle theory, a little bit of candle theory to understand if this is a possible place where I should attempt a little bit of selling. Now, I risk a small amount of money because it's not in the direction of what the fundamentals are saying. Now, what I did is, when price reacted from this zone, and what was my reaction in reality? Well, this red candle, right, this black candle, this candle you see right here, sorry, I said black, this drop you see right here, this particular candle, the drop is the reaction I saw from the supply zone. So if price is retracting from a supply zone, price is trying to start a short-term retracement, a short-term pullback. Maybe, I'm not saying it is, but maybe. Now take a good look at the situation. We've closed below that low that was created by this crazy candle before. Price has closed below it. And then when I see price returning into the clear extreme, so on the lower time frame, you realize that this right here is a very good supply zone. It's going to be a very good supply zone. And I see price, you see how price is reacting from this. This is a good time for me to sell. The same way price is already reacting from this, on the lower time frame, price is reacting from this. So I would want to take a small stab to the downside, hoping that that push price to my demand zone. But I doubt if it may or will, because we have a very short time between here and the next meeting. So I'll be watching this trade closely and see if it moves at all to the downside. But before I move on, let's go into the 1 hour and confirm if what I said was true. So you can see it right here on the 1 hour. This is the close below, and then this right here is the supply area I had highlighted, and you can see how this supply area is a clear supply area on the lower time frame, and price has very small reason to find its way through this area too much. But if it does find a way, it means that the power of the demand is still very high, and it's a good thing for me. It's a good thing because it says that my fundamentals are working good, but it's a bad thing because I can't join in on the trade yet. That is the only situation. I would love for it to pull back to a daily or a clear 4 hours demand zone for me to be able to come into this market. Over here, let's look for a clear demand zone for us to come into this market with. So as you can see, price has created a good area, but it hasn't created a good demand movement. If it had moved exotically or speedily past this zone, then they have a good demand zone on the 4 hours. So where is the next good demand zone we have in the 4 hours? Well, you can see right here, it is already being covered by the daily situation. So it means even if I want to place a trade in the first place, this is the only place I have a good buying situation. So I just have a daily buying situation right here. If price does find its way down here, I do have a reason to buy into it and take this market, or rather join this market to the upside. But then again, all of this we said is due to the fact that we looked at the economic data, and this is what the economic data is saying. The economic data can change because news is released every day and different things are happening in the economy. And if for any reason the economic data changes to the point where the central banks decide to take an opposing stance to what we currently have, we would have to change our bias. So fundamentals doesn't mean that the market is never going to change. The fundamentals mean currently, based on the entire data I was seeing, this is what we think is going to happen, and that is the way it works. Same thing as technical analysis. This is what you think the market is going to be doing. So that is it for this particular currency video, and I would like to tell you thank you for watching. Do have to hit the subscribe button because I know I did share really in-depth knowledge for you guys in this video. Do also hit the subscribe button, like and share this video with someone who you think will find this trading knowledge valuable to their trading career. I'll see you all in the next analysis and in the next video. Peace.